Hey, what's up, everyone? This is Mike from the Red Pill Economy. Thank you for tuning in. I really do appreciate it. If you are new here, we help people stay aware and get prepared for the incoming economic collapse of the U.S. economy. And I basically share news and commentary on what's going on with the economy as it is right now. And we don't sugarcoat things over here. So please, if you haven't done so, please like and subscribe. And we're going to get into this article right now. Okay, this is on Market Insider. I found this article, just wanted to talk to you guys about. The title of this article goes, "A credit crunch has started as banks tighten lending by the most on record," Morgan Stanley CIO says. And here's just a couple bullet points about the article. The credit crunch stemming from March's bank crisis has begun, according to Morgan Stanley's Mike Wilson. Wilson pointed to a big drop in bank lending and tightening credit standards in recent weeks. The data fuels Wilson's view that the stock market is in for more pain in 2023. And let's start with the article. The credit crunch stemming from the fallout of Silicon Valley Bank has begun, with data showing clear tightening of lending standards by banks, according to Morgan Stanley's top stock strategist Mike Wilson. In a note on Sunday, the Morgan Stanley CIO said that the last 2 weeks have shown the steepest decline in lending on record as banks scramble to offset the breakneck pace of deposit flight, which has accelerated in the months since SVBs failed. The data suggests a credit crunch has started, Wilson said in the note, adding that $1 trillion in deposits have been withdrawn from U.S. banks since the Federal Reserve began raising rates a year ago. Further illustrating the credit crunch is the most recent small business lending survey, which last week showed that credit availability has seen its largest drop in 20 years, coming alongside the highest interest rate seen in 15 years. That's worrisome for the U.S. economy and markets, which have already been squeezed since the Fed embarked on an aggressive campaign to raise interest rates and bring down inflation. Tighter financial conditions could raise the risk that the economy falls into a recession this year, as both companies and households experience difficulty obtaining credit. The spate of bank failures and ensuing credit crunch fueled Wilson's view that stocks are in trouble this year. Previously, Wilson forecasted as much as 20% drop in the S&P 500 in 2023 as corporate earnings drop, with the worst earnings recession since the 2008 recession potentially on tap this year. He notes that major indexes holding steady since the SVB episode should not be taken as a sign that everything is fine, but rather an indicator that stocks are at risk of a sudden drop, dissimilar to what has been seen as small caps and bank stocks since March. And that's pretty much the end of the article. And yeah, basically we're heading toward another credit crunch like 2008. Okay, banks are tightening their lending standards, and they're not giving out loans, and they're not giving out credit as much as they did in the past year or two. Interest rates are getting higher, and they're imposing more restrictions on obtaining credit and getting loans and such like that, stuff like that. So what happens during a credit crunch? What's going to happen? Okay, let's talk about that right now. Well, loans and credit is going to be much harder to get. Okay, the interest rates are going to be much higher, and borrowing costs are going to be much higher also. Okay, so these things are going to be much harder to get. A lot of people won't be able to afford homes because of high interest rates, and home sellers will have a tough time selling homes, causing them to lower the home prices. Okay, especially first-time home buyers. First-time home buyers are going to be hit the hardest by this because interest rates are going to be extremely high, and they may not qualify for a loan. More than likely, they won't qualify for a loan, and banks are going to impose much more higher closing costs. What else will happen during a credit crunch? Okay, there'll be a ripple effect on the economy. People won't be taking out loans as much, which is going to cost people jobs. As we've seen in the past couple months, a lot of lenders, they have laid off their loan officers, and thousands of loan officers have been laid off due to this tightening, this credit crunch. And pretty much this hurts the construction and real estate industry. Okay, so people that people aren't taking out home loans and building loans to build new homes or to buy new homes. This hurts those constructions and real estate industry, and we're going to see a slowdown in that industry. A lot of people that work in that industry are going to be laid off because higher interest rates and it's tightening. This also has a ripple effect on the economy, okay? People are not going to be spending as much, okay? And that means a lot of jobs are going to be lost. And you're going to see a ripple effect in this economy. If people aren't able to get these loans and able to get credit, that means they're going to be holding on to their wallet a whole lot more. And they're going to hold on to their pocketbooks a whole lot more. And they're going to slow down the spending. And, that means a lot of people in the service industry and different sort of industries, they're going to lose their jobs because their employers, their companies won't be making as much money anymore because their revenues are going to drop because people are holding on to their wallets. And a lot of people are wondering if this will be 2008 all over again. And personally, I don't think it'll be that severe, but we are going to experience a downturn and a recession. That's no doubt. We're going to have a recession. People are losing jobs, and the unemployment rate is going to rise. Okay. And we're just going to see a recession. I don't think it's going to be as nasty as 2008, but it's coming. I mean, don't. I mean, I'm already seeing a slowdown, okay, in a lot of different areas and a lot of different industries, and a recession is coming. I don't think it's going to be as severe as 2008, the housing crisis back then, but it's coming definitely, and we are pretty much at the beginning of it, and we're going to see the fallout from this, credit crunch and inflation coming this year. So that's pretty much all I have for you guys for today. I hope you guys enjoy this video. Please like and subscribe. Let me know what you think. Please share your thoughts, and I appreciate you guys coming through. I'll see you next time. Take care.